So my name is Jivan Sanghera. I'm the proprietor behind Circle Mortgage Group. First and foremost, I want to thank KMB Law for the opportunity to participate today. These are very fluid times, and good advice really is paramount in these situations. So thank you again for the invitation. Our company, Circle Mortgage Group, our motto is the best rates with some old school advice. My topic for today is obviously navigating the impact, an inside view of the mortgage market in the age of COVID-19. Who are we? So Circle Mortgage Group is my brokerage, Better Business Bureau certified, 5-star rated on Google. We're local, so we're in Burlington. We have offices in Oakville, Mississauga, and Toronto as well. We've helped well more than 2,000 families in placing their financing, and I'm happy to say that we're still accessible to those individuals, and we've fielded quite a few questions. I'd say that late March, early April, I had never had as many discussions about my clients and their personal financial situations being stuck in payment deferral situations, which we'll be going on to discuss in just a moment. I've been lucky enough to share my opinion before. So I've been featured on CBC Finance, Yahoo, Mortgage Brokering, News.ca, and I Love Mortgage Brokering. Not saying that to pump my own tires, more just to let you understand that I have shared my opinion before, and people do seem to rely on it on occasion. Circle Mortgage Group is obviously here to provide financing solutions in all sectors of residential and commercial finance. So we do first mortgages, mortgage renewals, and refinance and debt consolidation for people. A lot of times people don't necessarily look at their equity as an investment vehicle. We try and help people mobilize that equity so they can take advantage of situations that may present themselves for opportunity's sake. Our goal in process with our clients is always to make sure that our communication is excellent. So to that effect, we actually have a system that we have brought in that allows for digital signatures and digital correspondence directly with the client. So we do use DocuSign. Many of our lender partners are now accepting DocuSign documents as well. So as we move to a touchless society, Circle Mortgage is definitely on side with that and has the systems in place to assist your team and your investors with what they could possibly need. Another key point of our process is just making sure that clients are educated as to why we are selecting a certain product line. A lot of times when clients are dealing with their major institution, they're very often shown a mortgage commitment, and instead of going through the body of the commitment, are basically shown where to sign. That is not the experience that our clients have here at Circle Mortgage. We do everything we can to make sure that they are well informed about the product selection, and I know that KMB Law does a good job as well on the back end of making sure that people are comfortable with the mortgage they've selected. Again, this is some more about our access system. So, again, DocuSign is available. What I really like about my application system is that it is a smart system. It does have an artificial intelligence component that allows for my clients to understand the documents that we will require for funding. And for those of us that have purchased before, I'm sure you're well aware that, the basics are a letter from your employer and a pay stub. And then if there's additional incomes to be used, bonuses and whatnot, we get into your T4s. If you're self-employed, I'm sure you're used to the forensic examination that occurs when you're looking for financing. And we do have options for our self-employed individuals where they don't need to get quite as deep into their documents as they normally would not be comfortable doing.
Jivan, I have a question on that topic of self-employment. Sure. How have you seen COVID-19, because as you said, it's already very challenging for a self-employed individual to obtain financing.
Yes.
Has it changed during COVID-19 or even for maybe on one side, the self-employed individual and then the employed individual? What has changed?
Very important to know is that if somebody is claiming the CERB, the Canadian Economic Relief Benefit, it is affecting their ability to procure financing. There's some situations where people have, I'm going to use the word mistakenly, applied for COVID-19 relief and are still working. And in those situations, we're actually seeing scenarios where if a bank sees that you've obtain the benefit under false pretenses, that they may end up canceling the entire transaction. People are only in the business of doing business with people that they trust. And unfortunately, situations like that could affect somebody's application. For self-employed individuals, your application is adjudicated on the previous 2 years' finance history. So to that effect, their ability to borrow is not necessarily interrupted. The key driver in that situation, though, is that we are being asked the question of whether the client is still open and operating during COVID-19. So that would be one of the key differences. Beyond that, we have seen as well lenders within about 14 days of closing ask for another pay stub. This again is to ensure that there's been no interruption in employment. Obviously, banks are in the business of mitigating risk. So when they perceive any sort of risk, they raise their hand and they raise their red flags and start to ask for additional documentation. We're lucky to say that we have our clients well prepared for those situations, and we're very forthright in our presentation to lenders. So we haven't run into any issues personally where we're not able to fulfill a deal. Early in COVID as well, lenders did come forward, and I was lucky enough to be on a call with a lot of bank presidents that did say that for mortgages that they had already committed, it was their intention to fulfill those commitments. But
I'm going to ask you that question. That's interesting. Yeah, good.
Oh yeah, so they were fulfilling the commitments on that, but in the same regard, if a new application's employment had been affected by COVID, they were declining the application.
So would that include someone that's been temporarily laid off?
Unfortunately, it would, yes. So if they're laid off with a return to work date, we can attempt to mitigate that. But if they're laid off and they're on the CERB, I did have an example of this present itself last week where a client that we had pre-qualified prior to COVID was looking to transact. And unfortunately, they were both on the CERB. One person is a server and then the other individual was self-employed. And they were both having to use the CERB program. And because of that, unfortunately, their purchase plans have to be put on hold.
Okay, thank you.
No problem. I'll keep moving through here. So obviously there's two types of products available in the mortgage market. The spread between fixed and variable rates today has compressed to about 25 basis points. As such, for new customers, we are recommending a fixed rate mortgage in many situations. For people that are on a shorter timeline, we do still recommend the variable. The reason we're recommending the fixed over the variable right now is because so our best 5-year fixed rate today is 2.39%. The best variable is at about 2.15. Prime rises a quarter point at a time. So if prime goes up even once, which we do expect it to do, now we don't expect that for about 1.5 years, but we do expect it to rise again. If that happens, you'll actually be in line with what we could offer you in a 5-year fixed rate today. So the reason that we are offering and suggesting a fixed in this situation with our lenders is that the spread is so compressed that it's very unlikely that your average cost over 5 years would be below 2.39% by having used the variable rate mortgage. That being said, prior to the crisis, we were very much in variable mode because we were able to offer clients discounts of up to prime minus 1.1, which put them at rates today of 1.35%. So it's safe to say we're on their Christmas card list, but in the same regard, there is key differences in the product, penalty very much being one of them. I'm not sure.
May I interrupt you again? On the penalty point, as some of you might have seen recently in the news, there's a lot of articles coming up about people having to unfortunately sell their property because of COVID and not having an income. And you're seeing those individuals coming out and saying, I didn't know I had a closed mortgage. Now I have $30,000 to pay in penalty fees. How do you, I suppose, what's your thought on that? And what do you do to ensure that your clients are aware that there are penalties when you take the close term?
Absolutely. So actually, it's funny because it was the perfect segue into what I'm saying. But so as a matter of penalties, there's two structures of contract here in Canada, right? So when you're dealing with the big five, the way that their mortgages are written is that, for a very quick example, let's say that your interest rate is 3%. The way that the mortgage would be written at the big five would be, we have a posted rate of 5% from which we are giving you a discount of 2% for a mortgage rate of 3%. And as a regular consumer, most people will look at that situation and say, okay, my mortgage rate is 3%. But unfortunately, it's not. It's the rate of posted minus the discount. And where that comes to rear its head is actually when you go to close or pay off the mortgage. And the reason it comes back is that the bank now expects you to compensate it for the difference in the posted rate on your term remaining versus what you're paying. So the 5-year posted rate today is 4.94%. The 3-year posted rate might be as low as 3.3%. So if you were to take that same discount that this lender offered you up front, and no disrespect to any bankers in the room, but it is a very fictitious discount. But if you were to take that same discount and apply it to the term remaining, the lender may require you to compensate them for a loss of interest revenue of up to 2% per year for whatever term you've negotiated. The only time this doesn't take place and you're in a fixed rate mortgage is if there was no posted rate in the contract to begin with. And that's one of the things that we do to very heavily mitigate the possibility of a penalty structure, much like the one I'm about to highlight for a lady that happened and was shown in the CBC News yesterday. So what ends up happening is that we have our interest rate differential situation at one of our big banks where, again, they've given you this 2% discount. And now if just for example's sake, let's say there's 2 years left on the term and the 2-year posted rate is 3%, they will actually apply the same discount they gave you on the first day. So 3% minus the 2% initial discount. I'm sorry, I feel like I should have done a math slide for you guys. 3% minus the 2% initial discount means that, technically speaking, this bank can only relend your money at 1%. And now they're looking for you to cover the difference between your 3% interest rate and the 1% that they can cover for the entire time period of what's remaining on your mortgage. Say that there's 2 years left on your mortgage and you're in a $500,000 loan. You might be in a situation where if you have to pay them 2% per year, you could be paying them a penalty of $10,000. In our next example, this lady had a little bit longer to go in her mortgage. So yesterday on the CBC, it was highlighted that a client of Toronto Dominion, Christina Barabina, who is a realtor, oddly enough, was I don't know about was slapped with a $30,000 penalty, but she was charged a $30,000 penalty for her early termination of her mortgage contract. Had she been into one of our products where interest rate differential is not as much of a concern, her penalty could have been around $3,000, which would have represented about 3 months' interest. A study out of Quebec actually showed that when banks are using interest rate differential penalties, which they claim is because they suffer losses in those situations, that those interest rate differential penalties are sometimes more than 200% higher than any actual interest loss that the bank has experienced. So that's something that's very important, because I believe personally that in a like situation where you have product A and product B, and product A carries this penalty of up to $30,000 or up to 4 to 5% of what you originally borrowed, which on a $500,000 mortgage again could be $20,000 to $30,000. I personally believe that a customer given the opportunity to sign a similar product without the same stringent penalty terms would take that product. Banks do work with people in interest rate differential situations where, if they can try and port their mortgage. But a lot of clients that are calling me today are looking to take advantage of low interest rates in this market. And what ends up happening is that because they're in an interest rate differential situation, they aren't necessarily in a position where they can leave their institution and still find savings on the back end. And in some cases, you can certainly do that, but the window to actually get into a period of savings versus expense is sometimes more than 2 years. In the in the just in time immediate satisfaction society, it isn't necessarily something that would draw people to better their financial situation by incurring that cost. Very few people like spending money to save money. But that being said, one thing that this client group can trust and your team can trust is that when they're dealing with Circle Mortgage and they're dealing with myself, we are making sure that they are more than well educated to the fact of the way that the lender is charging penalties. And that's why when we are dealing with our larger institutions, even in scenarios like today, I am recommending the variable rate mortgage at those places just to ensure that clients are not faced with interest rate differential penalties.
Great, Jivan. I think often as human beings, we focus on certain things. When we're dealing with an agreement of purchase and sell, we don't necessarily read all the fine prints. When we're dealing with a mortgage product, we don't always, I mean, your lawyer does, but as an individual, we don't always focus on the small prints. And if working with professionals that can guide you through the process, whether it's the agreement of purchase and sell, whether it's the mortgage product, and explain to you the pros and cons of each product, or the pros and cons of the agreement of purchase and sell, it's really critical. You may not find yourself in a situation like this lady with a $30,000 penalty if you do that at the forefront, right?
Yeah, Christina, that lady is a very interesting case study because she's an industry participant. So our expectation of professionals that are assisting us is that they have the knowledge to be able to at least navigate the market for themselves. The one other point to what you're saying about having professionals you can trust, in all honesty, I'm very happy that KMB has opened an office here in Burlington, and I look forward to working with Gideon. But beyond that, what ends up happening is that, especially in this digital signatures age, it's very difficult to know that your client has actually read the contract. And as you said, that's why it's so important to have professionals on your side that are making sure that you understand the key points of what you're getting yourself into. In listening to the presenters before me, I got to say KMB is doing a great job of making sure that their clients and our clients by default are well aware of the situation that of what they're entering. So I think it behooves all of us to make sure that we don't assume that our client understands. And that's something that's very important here at my company, is that education is key. And hey, if after we've educated to somebody to, the potential negative effects of them having a mortgage of a fixed rate with their major institution, if they still choose to walk down that path, then hey, what do you do, right?
Yeah, they're educated. That's the key. As professionals, that's our role, to educate them and make them aware of the risk. But the level of risks that they want to take, that's up to them.
Like I said previously, given the opportunity to have two fairly similar items with the penalty clause being the major difference, I can't personally understand why somebody that is understanding what's being explained to them would select option A. But again, major banks process more mortgages than mortgage brokers do. So they're saying something effective in getting people to complete their transactions with them. I just don't know what it is.
Well, thank you so much, Jivan, for your input today. It was greatly appreciated. Great presentation. Touched on a lot of really key points, and they're, really right now current. I think it was very informative. So thank you so much.
Sure.
More business for you. So we're going to move on.